Banana Kitchen launched a chicken sandwich in 2019 and fundamentally changed the trajectory of the brand. Same-store sales growth that followed was some of the strongest in the QSR industry, and the NNN investing community took notice. Today, Popeyes is one of the most active BTS programs in the chicken QSR space, with 20 to 25-year absolute NNN leases on corner drive-through pads. Here's what you need to know, and the key caveat that most buyers miss. Popeyes NNN properties trade at 5.5% to 6.7% cap rates, with the wide range driven entirely by guarantee structure. Corporate-backed or strong franchisee-backed deals trade at the tight end. Weaker franchisee deals trade wider. Buildings run 2,200 to 2,800 square feet on 0.75 to 1 acre drive-through corner pads. Entry prices range from $1.8 million to $3.5 million. Lease terms are 20 to 25 years, among the longest in the QSR category, with absolute NNN structure common and 10% rent bumps every 5 years. Restaurant Brands International is the parent company, also owning Burger King and Tim Hortons. The Popeyes thesis starts with brand momentum. The 2018 chicken sandwich launch is not just a marketing story. It drove sustained same-store sales growth and proved that Popeyes can compete at the top tier of the chicken QSR category alongside Chick-fil-A. That operating strength makes Popeyes franchisees more profitable and therefore more credit-worthy guarantors on NNN leases. The 20 to 25-year lease terms are notably long for the QSR category. An absolute NNN structure is common on Popeyes deals. Cap rates are wider than Chick-fil-A or Chipotle, which means you're getting higher current yield in exchange for accepting franchisee credit risk rather than corporate credit on most deals. Most Popeyes NNN deals are franchisee guaranteed with 20 to 25-year absolute NNN lease terms. The franchisee pays all operating costs, taxes, insurance, maintenance, roof, and structure for the full initial term. Rent bumps of 10% every 5 years are standard. RBI corporate guarantees on Popeyes deals are rare and trade at premium cap rates when they do appear. The critical variable on every Popeyes deal is the franchisee, the identity, operating history, and financial strength of the operator behind the lease guarantee. The non-negotiable due diligence item on Popeyes is the franchisee. Request the franchisee's financial statements. At minimum, the last 2 years of tax returns and a current balance sheet. A well-capitalized multi-unit operator with 20 or 30 Popeyes locations is a very different credit risk than a single unit franchisee opening their first restaurant. Understand how many locations the franchisee operates, whether they're current on their franchise agreement, and whether they have other business interests that could divert attention from the NNN lease obligation. Second, the chicken QSR segment is now genuinely competitive. Chick-fil-A, Raising Cane's, Wingstop, Zaxby's, and others are all fighting for the same consumer. Popeyes has proven it can compete, but the segment is not without risk. Third, do not assume all Popeyes deals are structurally equivalent. The lease terms, rent schedule, and franchisee quality vary significantly. Popeyes NN can be a strong investment when you've done the franchisee diligence and found a quality operator behind the lease. I'm Ryan Solberg with MaxLife Commercial. If you want help evaluating Popeyes NN properties in Florida, including walking through the franchisee analysis, reach out. Visit maxlifedevelopment.com or call 321-586-2121.